I'm delighted today to be interviewing Richard Harpham at XP Factor. Richard, how are you to this morning?
Really good. Thank you so much. How about yourself?
Yeah, I'm very good, thank you.
Good.
Some impressive results you guys published this morning.
Yeah, really, really pleased to have the results out there. Obviously, it's the manifestation of a very, very significant growth period that we've had over the last 18 months or so. So yeah, exciting to be able to talk about them with you.
Great stuff. Well, I noticed the group revenue, I mean, more than doubled to so almost 57.3 or something.
Yeah.
What were the key drivers behind that?
Well, so you might remember that we had a really aggressive period of openings growth through 2022. We opened a very, very significant number of sites, particularly on the boom side. And so what you're seeing in the 15-month numbers to March this year is really the kind of the culmination of those sites coming online and growing and maturing, but also the pre-existing sites. That is the sites that have been trading for more than 12 months that are now like for like, also performing incredibly well for both businesses. So to put that in context, within Escape Hunt, the like-for-like performance was at 17%, and Boom at 22%. So really, really very, very good numbers to see. And when you remember that that growth is entirely volume-led, there's no price in that at all. So that's a footfall growth number for both businesses. That starts to tell, quite a little bit of the story. In absolute numbers, the big driver behind it is obviously Boom, and as we just discussed, the growth of the site openings through 2022. And what you've seen there is a business which I appreciate the counterfactuals a bit odd, but the 12 months previously where we generated £9.5 million of revenue in Boom is now sort of superseded by 37 just over for the 15 months just gone. So really quite a significant growth and sort of momentum being garnered through that business.
Okay, so yeah, I was looking at the Ebitda numbers. I mean, you're just under sort of 10 million there. I mean, is that down to the growth then, or was there any cost management efforts or strategies that contributed to this?
Yeah, well, just to be clear, the 10 million is sort of a post IFRS 16 number. I think for consistency normally talk about pre IFRS 16, where we delivered 6.3 million pounds of EBITDA. If I'm honest, a little bit ahead of the market expectation.
Hmm.
And in terms of constituent parts of that, really that is about the businesses, kind of continuing to grow, sales being leveraged. So you've seen GPs remaining very strong. You've seen on the Escape Hunt side that the site level EBITDA generation held at 42%. So it's a really, really strong performance in that business. You've seen on the Boom side, combined aggregated EBITDA at a site level was 17%, up from 13%. And when you remember that within that, there's quite a lot of dilution for Boom because you've got so many new sites coming on, and new sites will typically lose money before they start to make it. So you've got a bit of a dilutive effect in there, but very much on track for the 20-25% EBITDA that we're targeting in that business. So really the growth there is all about the sites. It's about the site delivery. In fact, actually quite opposed to what it is that you were suggesting around cutting costs. We're not that business at this stage. We're far more about investing in the right lines in order to grow sales. So we're investing in team, investing in supply chain, investing in head office, investing generally across the business. So you're not seeing EBITDA up as a result of cost cutting. You're seeing it as a result of quite significant growth in customer numbers.
Okay, well, that's great to hear. I also noticed there was the Capex, sort of 8.3 million. How do you manage the sort of, can you talk us through how you manage that sort of significant growth and that kind of investment and maintain a healthy cash flow? That must have been quite a
Yeah.
challenge.
Yeah, it is. I mean, we're lucky to be in a business which is pretty cash generative, and so to be able to fund 8.3 million pounds of capex out of organically generated cash flow is a really bit of a privileged position to be in. In terms of the way we think about the allocation of that, we typically think about three blocks of expenditure, if you like. So one is new site growth, and in terms of new site growth, we spent circa £4.5 million on new sites, so around about £1 million in Escape Hunts, around about 3.5 in Boom, just on building new sites through that period. We then spent quite a lot of money on, as we would define it, expansionary capex. So that's where we can see demonstrable latent demand in both businesses. So for Escape Hunt, that might be where we can see quite clearly that if we normalized a demand curve for the busy periods, i.e. we match the demand curve to the quieter periods that we have, and then overlaid them onto the periods where we know we're full, what's that suggesting we have in terms of headroom for latent demand? And where possible, we've gone back and put more rooms into pre-existing sites to try and close that demand gap. Similarly, for Boom, we do a lot of work where we understand the marginal returns for every incremental incidence of a games lane in inverted commas. So where possible, can we add more of those? Can we add more bar capacity where we know we're 6 deep on a Saturday, we're not getting enough drinks into enough hands quickly enough? So that expansionary capex, we spent around about £2.5 million of the 8.3 on that across both businesses. And I think that sets a good foundation for hopefully additional growth to come. And then the delta is in maintenance, which, of course, in our kind of industry, where fortunately these sites are being used by a lot of people, you just have to have a little bit of refresh going on constantly.
Okay, that's great. I mean, I was going to ask you how you ensure that the new sites and acquisitions integrate smoothly into the group, but I think you've covered that already.
Actually, I mean, the one thing I would say on that, that's more a culture piece than anything else. So when you bring sites on, actually, yes, there's a bunch of pro forma stuff in and around the way we think about them and building them and so on and so forth. But actually, the integration of new sites and acquired franchisee sites always comes down to team and culture. So how you make sure you've always got the right teams in place that marry to the brand values and DNA. That's, I think, where success comes from.
So would you say that strategy that you've implemented has helped to increase the sort of site level EBITDA margins and sort of the high return on the capital you're achieving?
100%. It's that obsessive focus on trying as best we can to do the best we can by our customers is the thing ultimately which creates, God willing, brand ambassadors from the customer set and also allows us to continue to grow. We've talked for quite a long time about the sort of customer review aggregated scores that we receive. 98, 99% of very positive satisfaction across both brands. We sit absolutely at the top and above the industry as a whole by quite some margin. And that's all down to the work that the team do in and around culture. So it's a really, really important facet of the business for us.
Good stuff. I was also interested going through the one thing that came up was sort of franchise versus owner operator. And how do the performance of those compare? Sort of the franchise compare with owner operator sites, and are there any particular considerations you're looking at when deciding between each model?
Well,
For expansion perspective, I'm talking.
Absolutely. So at the moment, what you've seen is our taking more sites back than adding to them in terms of the franchise piece. And so far, what we can show quite clearly is that where we have taken sites back, typically performance has improved quite significantly. There's this sort of inflection point beyond which we then grow. And that's I think, born in a large part of the fact that because we as owner operators now have quite a large number of sites, we're able to spread more marketing resource, more financial resource, more resource generally against these sites than perhaps some of the operators who we had in play may have been able to do. So that's definitely to the betterment of the site performance. Philosophically, we still really like the idea of franchising, but I think for us, rather than perhaps some of the franchisees who we may have had in the past who haven't been able to grow with the business, haven't had the funding to be able to do, let's say, 10 sites. We feel that the opportunity further down the line might be to try and find a partner that can do very, very much more business, and that becomes a bit more strategically relevant. So at the moment, we're kind of tidying up the ship a little bit, setting that foundation to give ourselves the option, maybe to franchise at greater scale, maybe to really go after it all in terms of owner operation. But either way, putting that foundation in place to create the option, I think, is the right move strategically.
Okay, so you're happy to move. Are you happy to move away from franchising? Are you looking to prioritize other opportunities then?
Well, I think for us, it always is going to come down to return on capital. And while we're returning capital on the Boom side at 52% and on the Escape Hunt side at 48%, with the best one in the world, capital notwithstanding, if you have it, it kind of makes sense to invest it. Because that's that's a returns profile that sits, pretty high against the industry. So if we can do that owner operated, kind of pays to do it.
Okay, I mean, that's interesting. And I noticed there was sort of you've got a continued like-for-like growth, in the market itself, so market positioning, everything. So what are your expectations for the consumer demand and market conditions going forward?
Yeah, I think we've been in a really fortunate place with the business that our like-for-likes, particularly our volume like-for-likes, I do stress this point that our like-for-likes are entirely volume. We have no price and have not taken price for years. And so within that within that volume-led like-for-like, we're absorbing the incremental costs as the minimum wages have gone up. We're absorbing supply chain increase. We're absorbing the electricity crisis in inverted commas of a couple of years back. We haven't pushed price. So that volume-led growth is really significant, and it sits very, very, very much removed, I would say, from the industry per se, where typically volume-led like-for-like is quite significantly down, and any like-for-like that is positive is coming from price. So we've been in a very fortunate position to be able to somewhat buck the trend of the market. Now, can that continue at the levels that it has been continuing in these huge double-digit numbers forever? Of course it can't. And nor would we expect it to. Typically a business would expect to see, pretty decent like growth in year one, come off slightly in year two, and then normalize at, kind of 2.5%, including price. The fact that we've, in a business like Escape Hunt, for example, seen these huge double-digit volume-led like-for-like numbers for so many years, that's not normal. You can't expect to replicate that generally. That's been a huge sort of benefit to the business, and certainly way outside our expectations. And on Boom, sorry, you've again seen these huge like-for-like numbers, which will of course have to come off because there just isn't the capacity for them to continue to grow if we don't wish to push price. However, we're still in this wonderful position right now. We're still seeing positive like-for-like growth, volume led. We were in a pretty good position in Q1 financial. That's kind of Q2 calendar now. Summer was a little bit softer for us, impacted, if I'm honest, by the riots in August, where, as you can imagine, that took quite a hit on the business. But now we've kind of gone through that. Like-for-like's coming back up again. So you'll see we posted numbers for both businesses this morning in the post period at circa 2%. That's that blended rate that had the sort of the dilution from August within it, but now already we're seeing like-for-likes back on the climb again. So we'd expect to see really good, strong like-for-likes volume led for the year, but they can't possibly continue at almost 20%.
On the note there of the riots and everything, do you do events such as a football? I mean, that must have had a huge sort of positive impact then.
Well, it's interesting. Of course, we have two businesses. So for Escape Hunt, football is negative.
Yeah.
That just fundamentally takes people away from the business. For Boom, it's probably not much better than neutral. It's a really funny thing. I think everyone always assumes, bars must do fabulously well when football is on. And it is definitely true to say that if you're all out a sports bar, that's a really good place for you to play. I'm sure we're not, and we don't want to be a sports bar. And so typically what you see in terms of your dynamics it's broadly neutral, because you might have got a lot more customers in there, but during that 90-minute, 2-hour period, people are not going up to the bar as much. They're not buying as much by way of drinks. And so actually it kind of nets. We're marginally positive on Boom, but it's definitely not a massive driver of positive like-for-like in the way that maybe people might assume it would be.
Well, I'm a rugby fan, so you won't see me in this sport. I'll be avoiding them. I'll be attending Boom bars or wherever the football's on, if I'm honest. But I also noted in the sort of numbers you've got this £10 million credit facility with Barclays. I mean, what role is that going to play in the growth strategy?
Yeah, I mean, this is really, really good news. And last time we spoke, I think we talked about the fact that we were hopeful we may achieve, this very, very vanilla RCF, which we have now obviously gone on to have full credit approval for. So we don't expect to be drawing too significant a proportion of that, certainly in the short to medium term, over any kind of a period. What it does, however, is allows us to much better marry the working capital cycles of the business's trade with when you would want to build sites. So if you imagine fundamentally, businesses like ours make the most cash, generate the most cash in calendar Q4. Pretty obvious. So obviously what you really want to be doing is building all your sites before that. You really want to be building your sites in calendar Q1, calendar Q2, such that you're ready for Q4. But that does somewhat disconnect the timing of the cash that you've generated in order to organically fund the building of sites with the time when you most wish to do them. So what this facility does more than anything else is allows us to smooth that gap. It will allow us to do some more sites over and above that, which we could fund organically. But actually, that timing piece is almost the more important. So it's really exciting for us. You'll see us be able to pick up the pace a little bit. As I say, marry better to kind of the timing cycles of our kind of industry. But it's a really strong endorsement, I would suggest, to have Barclays back it in the way that it has.
It is indeed, yes, very impressive. One thing that concerns me slightly with businesses when they are expanding so sort of quite aggressively, how are you ensuring that business is remaining scalable? And I mean, well, obviously you've got financially, you've got the support there, but operationally, very often they can fall over. What are your measures to ensure this doesn't happen?
Well, I think as a business, we have always invested quite significantly ahead of the curve. I mean, we talked about this actually a few moments ago, in the context of the drivers of that Ebitda growth, where you specifically asked if we were kind of cost cutting in order to get that. And
Yeah.
as I said then, quite the opposite. We are investing in platform foundation, people, system in order to allow us to grow. And you'll see that in our numbers. You know, you will see sort of a central support cost, which is still high in relative terms, relative to a kind of a mature industry standard. But I'm not apologetic for that because it allows us to deliver the quality experience that we want. It allows us to deliver, at the very top end for customer relative to competitors. It allows us historically to have delivered these like-for-like growths, and I think that these are fundamental building blocks that give you confidence into the future. And I might just make the point also that the year when things could have fallen over, I suppose, would have been 2022. We went from ostensibly next to nothing on the boom side to 30 odd sites. So that was the year when the build program was crazy. We had to hire over 1,000 people. We had some enormous amount of pressure on brand integration, brand creation for Boom, if I'm honest, then the integration into XP, then how do you make sure that escape hunt's not falling over? That was a really big year, but we got through that well. Now that we're opening, 7-ish sites a year, that'll grow a little bit. That's quite small almost in the context of what we have done. So with the requisite investment in the right areas, I'm very confident the business thrives.
It sounds like you got the right HR team in place there.
You certainly have a lot of people management. That's certainly true.
So finally, I mean, the sort of $1 million question, I suppose, is what do you see as being the biggest risks or challenges you've got now going forward?
Suppose it's always going to be the same one. It's the risk that what you do falls out of favor with customers. That's for any consumer facing business, that is the existential threat, I suppose. And I think that we are in a good position for a whole number of reasons. I think that we're in a very good position on escape hunt because it is such a young industry that requires so few customers to come through the door each day for us to do really, really well. If we get 80 to 100 customers coming through a site in a day, we've got fantastic economics. So in the grand scheme of the pull of an area, that's not very many to be going after. And escape rooms continue to be so incredibly well liked and received by customers, given that ours are at the premium end of that and in the best locations. I kind of feel pretty positive about that. And on the boom side, forever and a day, drink has been the galvanizer of social togetherness, hasn't it? You've been bringing people together in bars forever and a day. The fact that our bars at the moment happen to have a lot of great game in and around it to make that experience hopefully somewhat better isn't to say that those are the games that remain in favor forever, but they've been specifically built to be modular. So actually axe throwing tomorrow might not be quite so in vogue, but there'll be something else that is. The idea that the concept of coming together in a large space with drink and game as a way of enjoying yourself and getting together, the idea that disappears, I think it's quite tough.
Yeah, I was talking to a friend the other day about how you never see pool tables in pubs anymore. They seem to have completely disappeared. So how do you say? I mean, I'm fascinated to understand. I want to ask you how you know these new trends. Obviously, I don't want to give away any trade secrets. Well, listen, Richard, it's been fascinating talk to you. Thank you very much for your time this morning. I'm sure you've got a million other people to talk to and things, so I really appreciate you taking the
Well,
time out to speak.
really appreciate your time as well, and thank you.
Okay, thank you.
Bye bye.